Hello, folks. Okay, as promised, this is the problem on financial ratios. So what I'm going to do is I'm going to go through give you a little spiel on each of the ratios, and then I'm going to give you the answers that you should have gotten for the problem for your company versus what the competitor company. And then I'm going to tell you what's wrong with your company, if anything, and what you would do to mitigate it. All right?
Recording.
All right, so we have a number of different. Wait a minute, Joel. We have a number of different ratios we're going to go over. First group is liquidity. Okay, you've got the current ratio, the quick. Another name for it is acid test. And I'm going to add one, working capital. Okay, so the current ratio is total current assets divided by total current liabilities. Now, these are called rules of thumb, and they only apply to the liquidity group of ratios. All the other ratios are going to be based off of industry averages, okay, or industry specific. So for the current ratio, you would like that to be 2. Your current assets are twice your current liabilities. For your quick, okay, it's going to be total current assets minus inventory divided by total current liabilities, and you like that to be 1. Now, the reason for this is the acid test or quick ratio is going to basically check your current ratio, because if you'll think about it, what are your current assets? Cash, accounts receivable, and inventory. Okay? Those are your current assets, CA. Well, all right, so what happens if an industry or firm can't sell its inventory? Your current asset, this number, the inventory, continues to rise, so that means your current assets continue to rise. So it means your current ratio is going to keep going up, and it's going to look like you're much more liquid than you really are. So what you do is you check the current ratio with a quick ratio. So if we delete inventory, what's left? Cash and accounts receivable. All right. So cash and accounts receivable should be 1-to-1. Your current assets compared to your current liabilities. But the problem you got there, let me draw a little line here. The problem you got with that ratio is going to seep down into the next group of ratios, which are known as your activity or utilization ratios. And the first one there is called your DSO. That's days in sales outstanding. And it is accounts receivable divided by annual sales divided by 365 days. Now, folks, you got to do this part of the ratio first. Take your annual sales divided by 365 and get a number, and then take that number and divide it into accounts receivable, or you're going to throw your calculator into exponents, which mean nothing. So we're going to take the DSO to check the quick, because remember, the quick is just cash and accounts receivable. Well, how many companies do you know in the United States that collect 100% of their accounts receivable on time? None. So what this is going to do is this is going to tell you how long it takes you to collect your receivables as an average. Okay? So we're going to check to make sure that the quick is actually fairly in line where it should be with other types of what I call peers, which are companies in the same industry that also have the same size assets and same size sales. Okay, so your DSO is going to check your quick, and your quick checks your current. That's how it works. Now, you still got working capital. Well, that's total current assets minus total current liabilities, and obviously you'd like that to be positive. If your current liabilities exceed your current assets, you're probably not going to be able to pay your bills. Okay? All right, so now we get inventory turnover. All right, and normally that's going to be sales divided by inventory. Okay, but we're going to do this: costs of goods sold divided by inventory. Okay, and the reason is that sales has a profit margin. So what you're doing is you're going to get an abnormally or incorrectly high inventory turnover if you use sales. So cost of goods sold is the actual cost of producing a product, and an inventory turnover ratio is supposedly checking how many times a year do you turn your entire investment. Okay, well, your investment is cost of goods sold. So we're going to do that. Okay, now let me asterisk this. Whenever you see the inventory turnover going down, that means that basically your inventory is being built up and the company can't sell their product. Okay, so this is your first sign of financial deterioration usually. All right, then you've got two other ones. This is called your, fixed asset turnover. And your total asset turnover. Okay, so what this is sales divided by fixed assets, and sales divided by total assets. Okay, now these two are utilization. What you're doing is you're checking to see if the firm has not enough assets or too many assets. Okay? And again, you're going to be comparing these to industry averages. All right. The next group is debt or leverage. Okay? And the first one is your debt ratio. Then you got another one, your times interest earned. And then finally, I'm going to give you another one here, your fixed charge coverage. Okay, so the debt ratio is total debt divided by total assets. Now, total debt, folks, is everything on the right side of the balance sheet except for your owner's equity accounts. That even includes preferred stock. So the only two things that probably would not be included in total debt would be common stock and retained earnings. Everything else, these are excluded. Okay? All right. And the higher this, the riskier the firm. Okay, times interest earned is EBIT divided by interest expense. And the higher this, the less risky. Okay? Yeah, because what you're doing here is on the income statement, EBIT is what's going to cover interest expense, because that interest expense will be your next deduction from EBIT. And it's a multiple. So obviously, the higher the multiple, the less risky because you're covering your interest many more times. But what about if you got leases? Or what about if you've got what they call sinking fund requirements by either statute or contract? That's where this one comes in. It's EBIT plus lease payments divided by interest expense plus lease payments plus sinking funds divided by 1 minus the tax bracket. T is tax bracket. And what this does is, if you're looking for off balance sheet items, okay, that would be leases, all right? And they can use leases to try to fool an analyst to make them think they're not as leveraged as they really are, because, see, leases will not show up if they're financing leases, which means you have no obligation to purchase the asset after the lease period. What happens then is it doesn't show up on the balance sheet because there's no equity in that lease, but it does show up on the income statement when you pay the lease expense. So what happens is, it would look like if you did this ratio, the total debt ratio, and you had a lot of leases, it would look like you were less leveraged than you actually were. This is going to pick up on all of that. Now, a sinking fund, there's a number of sinking funds, okay? Let me write this down. Financing, off-balance sheet financing, that's what a lease is. There's a number of sinking funds, all right? Preferred stock, dividends, that's one, okay? This is a big one. ERISA, that stands for Employee Retirement Income Security Act. So if an employer says they're going to match whatever you put into your IRA, they have to do it by statute. And if they don't, the IRS will come in with a lien on all of their income until they do pay it. So if you're a lender and you've lent this company money and they've got an ERISA lien, you're in trouble. Okay, some of the other ones are principal repayment on bonds. Just say on debt, okay? Because all we've paid so far is interest expense. All of these come out, and there's a lot more, but that gives you an idea. All of these sinking funds are created by statute or by contract, and they all come out after tax. That's where this 1 minus T idea comes in, okay? I'll get it right in a minute. 1 minus T, okay? Because let me show you what happens. Let's say you want to pay $1 of preferred stock dividends, and you're at the 40% tax bracket. Well, that means for you to pay $1 worth of after-tax preferred stock dividends, if you're at the 40% tax bracket, you have to earn $1.67 before tax to pay $1 after tax. Okay, we got one more group of ratios now, and that's profitability. And we're going to talk about the three of those: net profit margin, ROA, ROE. Okay. ROA is return on assets. ROE is return on equity. Okay, so net profit margin is simply net income divided by sales. And what this does is it says, well, how much of every sales dollar does the company get to keep after they've paid all their taxes, expenses, and before dividends? Before dividends, that's how much they get to keep of every sales dollar. Okay, that's great, but it doesn't say a whole lot. We need a little bit more involved. ROA is basically net income divided by total assets. Okay? And ROE is net income divided by something called CE. All right, now CE is basically common equity. Which is the sum of common stock plus retained earnings. Okay, you need to know that. We're going to be using common equity term the whole semester. Okay, but if you'll think about it, if you just calculated ROA and compared them to your competitors or your peer groups, and yours was lower than theirs, would it tell you why? And the answer to that is no. So what we're going to do is we're going to do something called decomposition. Okay? Another name for it is DuPont analysis. All right. So here we go. ROA is basically the cross product between your net profit margin times your total asset turnover. Now that would be net income divided by sales times sales over total assets. Okay, so what happens if you take out the common term? What are you at? You're at what we started, net income divided by total assets. Okay? All right, so why did we do that? Well, now you're going to know if your ROA was lower than your competitors. Why was that? You got a good idea of figuring it out now, because it's either going to be because of your profitability or because of your asset utilization. Okay, but what about if I'm interested in ROE? Well, guess what? ROE is nothing more than ROA times something called the equity multiplier. Which is total assets over common equity. And again, what happens when you take out the common terms? You end up with what you started with. Okay, so this part of the equation is ROA, and the equity multiplier, if you multiply it by ROA, you get ROE. All right, what's the equity multiplier? It's basically saying that what you do is you use debt as much as you can. Don't overuse it. And if you have too much equity out there, you use debt and buy back some stock or a debt for equity swap. You want to try to utilize the advantage of debt because it's the cheapest source of financing your assets, because you get to deduct every dime that you pay of interest on debt. You don't get to deduct dividends. Okay? So if ROE was a little bit lower than your competitors, what normally happens? Well, usually it's right here because you got too much stock outstanding. You're too conservative. So you start doing a little bit more with leverage, not too much. Make sure you say that. And that should take care of the problem. Okay? So let me go ahead now and put the answers that you should have gotten for the problem that was assigned. And this problem is on page 124, problem number 314 on page 124. Okay? And it gave you a number of ratios that you needed to calculate for Jimenez Corporation, because it gives you the balance sheet and the income statement for Jimenez. Okay, so here we go. Your quick ratio, then your current, inventory turnover, Days sales outstanding, DSO. Okay. Fixed and total asset turnover. And let's see, ROA, ROE, net profit margin, and I like the debt ratio rather than the one necessarily being used in the textbook. Okay, so this is for Jimenez. And this is the peer groups, your competitors. Okay, so what numbers should you have come up with if you've done this problem for Jimenez? All right, well, Jimenez should have 0.85, a 2.7, now 4 to 4.8, depending on whether for the inventory turnover, whether you used sales or cost of goods sold as your numerator. All right, and then DSO is 10. 2.34 is your asset turnover. 5.9 is your total asset turnover. Wait a minute. Yeah, that's right. 5.9, excuse me. And let's see, ROE is 13, ROA rather, is 13.07. Our ROE is 2.5. Okay, and then your, oh, I missed one. 0.85, 2.7, on 2.33. Can't even read my own handwriting. I'm sorry, folks. 10, there we go. That's my problem. Okay. 37, 10, right? Total asset turnover then would be 2.34. There we go. 5.9 is ROA. 13.07 ROE. Net profit margin is 2.5. And all right, let's go with this. He uses, debt ratio. Okay, want to make sure I got this right. And that would be 55%. Okay. All right, so that's a percentage. So is that. So is that. That's times. That's times. That's days. That's times. And that's times. And that's times. Okay. All right. So what he's got here is 1.0, 2.7. 7.0, 32, 13, 2.6, 9.1, 18.2, 3.5, and 55. Oh, 50. So, question here is, where's the problem? Well, it looks like that right there is a problem. Your inventory turnover. Okay, so what are you going to do about this? And why is that a problem? Because what's happening here, folks, is that you are letting the people. You've got way too much inventory sitting on hand. Okay, and that's usually what the problem is when inventory turnover is significantly below your peer groups. And if you'll think about it, if you're talking about 4 to 7, that means they're selling out their store 3 times a year more than you are. Okay, so what else does that seem to affect? Well, let's see. Look at this right here. Okay, and look at this right here, and then look at this right here. Those numbers are indicating that you're losing profitability here. Okay, you've got and here's this, way too much in the form of fixed assets. It's your turnover of fixed assets is not good. So you probably got too much fixed assets, but at the same time, this is causing a real problem here. Oh, wait a minute, I got these reversed. Don't I? Oh, that's right, 13, 10. I did it right. I was gonna say, wait a minute. Yeah, you're probably way too much inventory. So you've got too much in the form of fixed assets to create this inventory you don't need. So it's hurting your profitability too, if you notice. So what should you do? Well, one thing, if you didn't want to dump the fixed assets, if you thought maybe you were going to have a sales growth in the imminent future, what you could do is you could have put this in 2/10 net 30. Okay. What that says is that you want to be paid in 2 days, excuse me, 10 days instead of, or a maximum of 30. And if you do pay in 2 days, I'll give you a 2%, in 10 days, I'll give you a 2% discount on your account receivable to me. And if you do that, you're saving a lot of money. Okay, so what does that do? Okay, that means that you're probably, after you've sold all this inventory with a credit policy like that, you should be collecting whatever is outstanding faster. So that's going to reduce your DSO. This is going to go back down. All right, and when that goes down, you also try to sell off your inventory at a reduced price above whatever it cost you to make it. Okay, so you're going to sell your inventory at a lower price than normal, just a sale price. Okay, because you've got too much of it sitting on the shelf. So what are you going to do? So you're going to have an increase in cash by selling that inventory. All right, and then you take that cash and you pay off some of your debt. All right, that you're having to utilize to carry that additional inventory. So you pay off some of your short-term debt. So what just happened so you're going to pay off ST debt. That's going to go down from that cash. These two guys right here, because you're selling off your inventory at a reduced price. So what happens? Your inventory turnover is going to go up. Okay? And by utilizing this, 210 net 30, your DSO, your days sales outstanding, is going to go back down to as equal or below your peer group, which is good. And by paying off this debt, your profitability is going to go up. The only problem they have, and so is your net profit margin, and your debt ratio goes down. So the only problem you really have is that you got way too much inventory sitting on hand that you don't need. Okay? All right. So